to chapter 11 of Principles of Accounting 1. So right now where we're at is we're hanging out in our statement of cash flows. So after the journey that we've been on, we're finally at preparing that fourth financial statement. It's kind of been elusive up until this point, right? Where we've been like, okay, I know I start with my income statement to get my net income. From that, I'm able to prepare my statement of stockholders' equity, which I know I need my equity section to be able to prepare my balance sheet. And then from my balance sheet, I need this cash piece right here to be able to prepare my statement of cash flows. So we're finally at the point that we can look at and analyze this financial statement. So again, here's our basic accounting equation, and here's how these different things impact it. So over here, if you think about cash, it is a resource to the company. We can go purchase things with it. We can go invest with it. We can do a bunch of different things, expand our operations. And we always will say cash is king. People really care about cash, potentially, sometimes even more than net income. And kind of the reason behind that is because if you think about net income, it is foundationally, fundamentally based on accrual-based accounting, right? And when you have accrual-based accounting, we've learned, right? There are estimates in it. You're estimating bad debt expense, running that through your expense. You have different kind of accruals, right? Prepaids. The cash flow hasn't actually happened yet, and that's totally okay. But we say that net income, well, is that the best representation of a company? Some people are going to say yes, but a lot of people are going to say, what I really care about is how much cash do you have on hand? Because I think that gives me a little bit of a better insight into what you can go do with that cash. Okay. So cash is king. It's all about the money, and that's where we're going to be hanging out. So the first thing we're going to talk about are the classifications of cash flow activities. So super quick, a cash inflow means all the cash received. Cash outflow means all the cash paid. Okay, so are you on the receiving or the paying side? You have an inflow or an outflow. Then you're going to have your inflows minus your outflows, and that's going to be my net cash. So this could be a negative balance, right? Say you just happen to have more outflows than you had inflows. So I don't know, maybe you went and purchased a house this year. So you had $200,000 sitting in your bank account and you purchased it all in cash, but your business only made $100,000. You could have a negative net outflow. Okay, that's totally fine. So then the different activities are as stated. So operating activities, we're going to think of day to day. So cash receipts and cash payments for activities relating to revenue and expense activities. Investing, cash transactions related to the purchase and sale of long-term assets and current investments. So I'm going to think long-term assets plus investments. Investing activities, investments. Okay. And then financing activities, inflows and outflows from cash resulting from the external financing of a business. Okay, so I even specify lenders and stockholders. So I think about this as how are you funding your business? Okay, so you can either go out and issue common stock, or you can go get some sort of a notes payable from a bank. So this is what a completed statement of cash flow is going to look like, and what we're going to spend the entire time, today or throughout this chapter, preparing. Okay, so don't be super concerned about the details. That's what this chapter is all about. But again, you can see here that you have cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. So the first step, right, is to be able to classify these different buckets. Because if you can't identify transactions and be able to say what bucket they are, then your cash flow is not going to be correct, even if you get to the right balance, but your cash flow is not going to be correct because, well, you didn't categorize it correctly. So it's going to be put in the wrong section. So what are some examples of inflows and outflows from each activity? Well, you're going to find that on this slide right here. So operating inflows, again, this is just day-to-day business activities to keep my doors open. I'm selling inventory, I'm providing services, collecting interest, collecting income tax, and collecting dividends. So this is kind of a big one over here because the collection of dividends, if somebody is paying me dividends, US GAAP says that is an operating activity. Okay, same thing with interest and income tax refunds. Kind of some funky ones that we do think are relatively day to day. So they're going to be the same activities that are reported in the income statement to calculate net income. Again, outflows are just going to be the kind of like the opposite, where, hey, now I'm paying to purchase inventory, I'm paying for those expenses, I'm paying interest, I'm paying income tax. So investing activities, those are going to include transactions involving the purchase and sale of those long-term assets and current investments. Companies, usually are going to invest cash to replace or expand their business, whether that's like buildings, land, equipment. And they're included in the investing activities because they represent investments in what are called capital assets. So you might hear this referred to as CapEx if you listen to the news, okay? So companies might invest cash in other assets, such as stocks and bonds, with the expectation of a return on those investments. And then many of those assets are eventually, sold and generate some sort of a return. So then lastly, our financing activities, again, those are going to be issuing common stock or having some sort of like a lender relationship with borrowing and repaying debt. So here, any sort of cash inflow, right? You're receiving money or receiving cash from a note. So again, it's like cash is going up, notes payable is going up. Issuing bonds, cash is going up, bonds payable is going up. Probably have a premium or a discount, right? Then issuing common stock, well, cash is going up, common stock is going up, right? Well, now when I turn around and repay those or I pay dividends, that's going to be my outflows. So here's what's kind of funky though. Cash dividends paid are going to be a cash outflow from financing. So again, being able to say, hey, dividends received, operating, dividends paid, financing, you're probably going to see that come up on an exam because that's something that, test administrators love to see if you remember. Okay. So when we're preparing our statement of cash flows, where am I going? What am I getting information from? Well, I'm getting information from a bunch of different activities, right? Or a bunch of different information. The first thing is I'm going to look at that income statement, right? Because I know my operating activities are primarily day-to-day activities, and those come from revenue and expense items. I'm going to look at my balance sheet, and here we're going to look and see the change, okay? The change year over year from the end of last period to the end of this period to find inflows, and those can go to operating, investing, or financing, okay? So we're going to look at how we do that, but we definitely go to our balance sheet to understand the changes in the accounts. And then also any sort of like detailed accounting records, sometimes we need additional information to determine specific cash inflows or cash outflows during the period. So maybe we're going to go to some actual source documentations to understand what we have going on, okay? So last thing to talk about here is that we do have operating, investing, financing. We also have this guy. So this is our non-cash activities. And so that's going to be investing and financing activities that don't affect cash. So again, how do I know that this doesn't affect cash? Well, I'm just going to book my journal entry. I purchase long-term assets by issuing debt. Okay, so this is very similar to if you all go get a mortgage someday. I am going to say that I am purchasing a long-term asset. I'm going to say a building, which is similar to a house. And I do that by issuing debts. I have a note payable. See how there's no cash associated with that journal entry? I am just directly taking out a loan to fund the purchase of an asset. That's totally fine, right? But it doesn't affect my cash flow because, well, this never hit cash. Same thing if you purchase a long-term asset by issuing stock. Just instead of having a notes payable, you're going to have common stock. Conversion of bonds payable into common stock, exchange of long-term assets. So it's really kind of funny because even though it's non-cash, we do go ahead and have a note about it on our statement of cash flows. Okay. The other thing is too that you might throw it in the notes to your financial statements that investors and creditors are going to read to understand how you are performing. So again, you need to be able to identify the difference between these two statements. A company issued a long-term notes payable from a bank, got the cash, and then used that cash to purchase equipment. So again, I'm going to book that journal entry. I got cash from a bank and I issued a long-term notes payable. I then use that cash to purchase an asset or an equipment. So then my equipment is going up and my cash is going down. So I have a financing activity and an investing activity that are both separate. Okay. But cash is involved in both. So these are both going to show up again in my financing and investing section, respectively. Versus a company had a single transaction that involved in acquiring equipment by issuing a long-term note payable. Well, that's where I'm going to see, well, my equipment's going up, right? And then my notes payable is going up. No cash is associated with it. So you have to really look and kind of read and see what the fact pattern is to determine, hey, am I getting cash and then using that cash to do something? Or am I not getting cash and just exchanging like a liability for an asset in this case? Okay. So which of the following transactions would affect the amount of investing cash flows reported on the statement of cash flows? So just like I said, kind of the first step to even being able to do anything with this cash flow is to be able to classify them. So I would do that for every question because yes, I'm looking for investing, but I need to understand all of these different ones. So the sale of equipment, well, that one does happen to be investing, so I could stop there. But payment of dividends, I know that's a financing because when I'm paying it, it's financing. Purchase of inventory, that's operating. And then the issuance of common stock, that is also going to be financing. Now you could take it one step further and say, are these inflows or outflows? Well, I sell equipment, so I am getting an inflow, right? Somebody's paying me cash for my equipment. I'm paying dividends, that's an outflow. Purchase inventory, that's an outflow. Issue common stock, I'm giving somebody part ownership in my company and they're giving me cash. So that would be an inflow. So now I will see you guys next video when we prepare the statement, poof, cash flow.